Okay, everyone, we're back live with Connor here from San Francisco, actually. Connor's still in Chattanooga. So Connor here, everyone, the dice roller, the Messiah, we were up what? A couple weeks ago, 60, 70% year to
We
date.
were June 11th, we were 63.52%.
And Connor just kept hitting me up. Let's keep on putting on the risk. Let's keep on putting on the risk. And lo and behold, boom, Connor takes a 14% drawdown in about 3 days. And it gets to, I think it was like a 19.7 something percent drawdown.
Yeah.
So, now that everything Connor touches does not turn to gold, what did you learn about this little excerpt of a 20% drawdown in basically a week?
Yeah. Definitely. We kind of spoke about this before, but just make sure you're sized correctly and don't just because you are ripping and you're just printing money, that doesn't necessarily mean touch what's working. Just keep on what's working and don't just keep throwing money at it. Because if you do hit a draw and then the market decides to give you three draws and back to back, then you're struggling pretty hard. Rather than you just keep the size that you're at that's been printing money, just keep what's working, man.
Yeah, and Connor also, since that 20% drawdown, has also made like 10% this week of
Yeah.
the 14th through the 20th. So it may not be the best reinforcing cycle to do. But I kind of wanted to talk about the flaws of this because I think psychologically, what you just did, I kind of set the trap for you. In all honesty, like I knew this was going to happen,
Yeah.
and it's good to show this to everyone. But basically, even though we kind of got out of this drawdown, having kind of an after action port, we'll go through what we did well, what we can do better next time, and then what we
Yeah.
learned. So like initially, let's go like what we can do better next time or kind of what we learned in general. So I'm not sure if you picked this up, but when we were at that 20% drawdown and we lost 20%, we didn't change our sizing. So we were also sized 20% larger than we were when we took a 20% drawdown in 3 days. So if we didn't just so happen to have luckily gained back that 10% over 3 days, what would have happened if we were trading the same contract size and then we were 20% lower? If the same thing happened, like we took a 7% drawdown, do you think that drawdown would be bigger or smaller
It would be
as a percent
smaller
of your
because we
account?
took sizing out of it, right? It would be
Well,
small.
so it's the opposite. So we were
Really?
trading with a 60 grand account and we had a minus 7% date, and we still had the same amount of contracts
What
in
you're
power
saying.
hour. Then we had like don't quote me on the exact math. It's going to be, a little bit like basically a 50 grand account. And on the 50 grand account, if we would have had, because we have the same contract size, that minus 7% would have been bigger or smaller.
Bigger. It would have been bigger. I see what you're saying. Yeah, because
Correct.
when you have more capital to play with, it doesn't hurt as bad. But when you have less capital and you take the same exact percent, that cut sucks.
Yeah. So you basically like were at the craps table, lost most of your money, and then
And
took a
still kept rolling it.
and then took like a personal line of credit out with the casino to keep playing, and then you basically were able to pull out of it. And so like that's one thing, but the other thing I want to encompass on that is like you were also sized larger, and in order to work out of a 20% drawdown, how much of a positive gain do we have to get back to that initial 70% whatever return?
Would
So
have to
like
be 2x that.
not quite. So like minus 20%, we would need a 25% gain to get back to even. And if we had a minus 25% loss, we would need a 33% gain to get back to even.
Makes sense.
So basically, if you think about it, 20 to 25%, we can go back to our basic fractions. 20 over 25 is basically 4 over 5. So we had to make 20% more than we lost to get back to even.
All right. Makes sense.
So like think about this as the tax man. Like you sell health insurance at work, you kill it,
Yep.
you close a big deal, and you're like, I made 20 grand this month. And then the tax man says, well, normally you'd make 20 grand, but since it looks like you're doing so well, I want some more of your money. So now you only made 16 grand. So
Yeah.
like you can kind of think of it that way, but the volatility tax man, which is in options, he doesn't, hurt you when you're killing it and you're making more money. He actually charges you more tax when you're poorer. So
It
like,
makes perfect sense because your draws are bigger when the more money you have in the account because the same percent with more money is more money.
correct.
Like,
And
yeah,
the thing too is like we were minus 20%. We had to get 5% to get back to even. But since we were sized at the same size, if we took that minus 7% day with 20% less in our account, we would have had a minus 10% day. And then if we had a 30% drawdown, we would need like a 45% to get back to even. So you could clearly see where, like, if we would
yeah,
have been off one or two more days, we basically could have thrown away our entire year of trading.
yeah. I
But,
mean,
but the
can I
most
ask you a
logical
question? That's
solution,
just,
yeah.
uh, is there anything like, I know you trust the math. Get it? We're systematic traders. That's what we do. We trust the math. You don't let out. But um, someone with, let's say you had emotional bias in this. Let's just say you
Oh, yeah.
saw this and you were like freaking out. What changes do you make to go with, like, what, like, because obviously we're size bigger. We got up to like 60. I think we're at 60,000
Yeah.
when we're at 66%, so a little over 60,000. Do you What do you do? And you hit the first, let's say you hit that first draw 3,000 and you're like, crap, what do you do changing to the size wise? Do you take a couple trades off? Do you change the contracts? Like, what are you doing for lowering your size instead of
Yeah.
just rolling into it?
So there's like two parts that I want to bring up in regards to this. So like if your size too large, like you just have to cut like any biases you have, any like, oh, it's going to revert, because it's like the chances are if you're in a 20% drawdown and then like 20% of the time you could lose on everything, which would be another 10%, like you're just size too large.
Yeah.
However, like we're in a little different situation because it's like there's a lot of money in other accounts. So like this is kind of our play account and we're making a
Yeah.
series. But kind of the core concept here that I think a lot of people miss out is like they'll back test 6 or 7 trades, which gives you diversity and it helps. It's like going to make your portfolio return smoother. However, this is kind of the concept of what's called sequence risk. It's the
Yeah.
sequence in which those returns occur. So like we were running hot on the trading. So like we roughly assume we're going to have a 15% PCR, and we ended up actually only have it. And we were outperforming at like a 20% PCR. But what happened is we eclipsed the worst drawdown in the back test, because even though today with our, 20% drawdown, we're still at a 15% PCR. It just so happens that the sequence of those losses all happened like in a week, which had not occurred in the back test. So like, even though it's working correctly and we're getting that 15% expected value, the sequence and risk, the sequence in which we realized that was like big hot streak, big losing streak. And it could have gotten significantly worse because the losing streak could have gone longer.
Yeah.
Or if you remember when we looked at the correlation, you remember the correlation stuff, or you want me to
Yeah.
pull it up?
Yeah. The correlation in beta. Yeah.
Yeah. So like with that correlation, if you have like, let's call like a 0.2 correlation. So that basically means for like how one trade moves, the movement of the other can be explained. About 20% of that movement can be explained by the movement of the first one.
Yeah.
However, the flip side to this, what everyone misses with a diversified portfolio, is the other 80% is known as risk remaining or idiosyncratic risk. And if you break that down into like Latin, idio is basically like random. So like 80% of our uncorrelation is unexplained or random. So like
Makes sense.
if you have a 20% chance of like winning something, if you flip the coin enough, you're eventually going to get 5 in a row.
Yeah.
Even though statistically that's not likely, and even though the back test may not show that. So like no matter how good your portfolio is, no matter how good AI gets, maybe quantum computing can figure this out, but like by definition, statistically, 80% of the non-clustering of our trades is unexplained or random. So like unless you can predict like what randomness is, that's always going to be the risk. And
And that's
people
with the 20% correlation. Like, that's when your correlation is at 20%. Like, it's saying it's
correct.
20%.
People only focus on one side. So like if
Yeah.
you could put this in your words, it's like when there's a 20% correlation, the movement of asset 1 compared to asset 2 can be explained with what degree?
Yeah. With whatever the beta would end up being on that, right?
Well,
Like,
whatever the correlation is. So like 0.2 correlation would mean that it's the movements of each other comparative to one another are 20% basically explained.
Makes sense. Yeah,
But
makes sense. That's what you're
and
saying.
people look at that and they're like, I'm uncorrelated. I can't lose money. Look at
That's
my
okay.
net
Yeah.
lit curve in option omega. But what we just learned here is what's the other 80% and what's the risk involved with that other 80%.
Yeah, we just found out what that is
Well,
like you don't know what's going to happen in the other 80%. You could have 3 losing days.
yeah. And the other thing too is like you said it best with like don't know. And I really just want to simplify this for people. It's like you don't know because it's random. So like
Yeah,
whatever happens, it's just random. Granted, there's somewhat of a probability assigned to it, but like the sequence of which stuff happens is completely random. Like the way I would compare it is if you've, ever seen like the NBA, they run a lottery for like
yeah,
who
yeah,
gets
yeah.
the draft picks. So like, the shittiest team in the NBA basically has like a 8% chance of getting the number one pick. I'm making this up. The second worst team has like a 5% chance.
Yep,
So there's a bunch of randomness involved in that. And like being uncorrelated does help you have a higher probability of making money. But like the fourth worst team could get the first pick and you could be the worst team and you get the fourth pick because
yep.
that's just the way the sequence does it. And
Makes perfect sense.
yeah. And then this is the part that I really want to ingrain on you and that I think we could come back and talk about sizing next time is that when we're investing, even though we're getting our average return of 15% PCR, you could see that if we took a big enough drawdown, like 33%, we'd need
Yep.
50% to get back to even. We could basically lose all 15% of our returns. And in investing, your journey is it's called ergodic. Your journey never stops. It's just
Yeah.
you're continuously trading through time. So like you could get up to $10 million, and if at that size you ever took a 33% drawdown, you could basically give away the vast majority of your edge. So this is like a very like strong proxy of how we should think about our investing journey, not in expected value on a day-to-day basis, but like the path of that over a long period of time. Because I don't know if you remember, like I want to kind of show you the benefit of compounding, the drawdown of, basically volatility drag, and then how they meet with one another. So like you
Yeah.
remember last time when we talked about the compounding, like
Yep.
we made 4% month over month and we actually make it like 8%.
Yep.
And then this month we
It's
could,
the yeah.
it's the opposite.
Inverse. Yeah.
So you want to weigh those out. And right now you're like flying by the seat of your pants where you're like, if we make 100% return, then when we make 10% a month, we end up making 20% a month by the end of the year.
Yeah.
But you're balancing that with like a 20% drawdown where you could potentially, if you got a 50% drawdown, then you'd have to pay double to get back. So like that
Yep.
would completely wipe out 100% return. And things can cluster for longer than we think because markets obviously change. You know what I'm
Yeah.
saying? And we don't know how long it will take for the change to be priced in.
Yeah. And that is I'm feeling very blessed on the aspect of it that it didn't cluster longer than that, because I've actually have heard people in the discords that they're clustering longer than what I clustered. So grateful for that. And also like I you always think about the emotional bias of it is when we're talking about that, you're like so pumped about the compounding side, but I'm glad I learned this lesson this week, because now I have to see like this grounds you a little bit. You got to see both sides of it. So is there any changes that when you come to that realization, oh, I got to win X amount back after this draw because we're sized larger now, is the math still the math, or do you make any changes to your portfolio from here now
The,
to try
the
to
math is
protect?
still the math, but the path is never the path. That's
Yeah,
a nice
that's a freaking line
alliteration
right
right
there.
there.
I'm
Yeah,
looking
yeah.
through
So,
saying,
so like the expected value is always going to be the same, but you can like even though the risk to reward on an individual trade for the expected value is still amazing, the path risk to reward gets very dangerous as you size larger for a CAGR and as you
yeah,
size larger for a drawdown. So like we need to think about the math is good. I feel confident in the math. Now we need to think about the path of
yep,
how we're going about it. So, to frankly, skip through all these periods, whatever, like we started Connor with a, 40 grand account. He got a 60 grand. He made money. He took his drawdown. You know, let's just say arbitrarily Connor learned his lesson. I'm going to double his account. We're going to 100 grand now. And then now that Connor's at 100 grand, we are going to take a different mindset to our trading and we want to size for, I'm going to call it exit velocity. So like we're going to size in a way of consistency, which is like, how do we get this 100 grand to be like replace Connor's income? And then if that takes like 3 years, we're going to be committed to that path. So we're kind of taking a different mind shift where it's
100%.
like, you used to take big risk in your career to try and make more money, but it's like now that you have kids, you need to get like a secure baseline where you could potentially grow instead of just having all the ability of commission to grow. You know what I'm saying?
Is this kind of like what David was talking about when you talk about credit targeting? Like now we have a different goal, so now we can go back in and completely target
Yeah.
differently
And
on
then we'll
each
also
trade.
have the means to do it. So with a 100 grand account, we won't have to cherry pick trades as much. We can run a bigger portfolio. And then when we run the bigger portfolio, if we size everything at a one lot, we probably won't be oversized. So we're going to like start smaller than we think and go about this route. And for a segue to this, we will look at Connor's new trade that he bring here. So if you kind of want to chat about this new trade and why you chose it and what you learned, Connor, doubling down on power hour more.
Yep.
I'm fine with this because it can give us some diversity and it's tranched. So I think that could help a little bit. But if you want to chat about what made you choose this and kind of your
Yeah.
thoughts around it.
Yeah, it was, and I'm not going to just take all the credit for this one. Me and Jordy were talking about this one.
Yeah.
So me and Jordy were, if anybody hasn't met Jordy, he's a couple videos back. Awesome dude. But me and him were on Discord, and he was like looking at he was running a pretty similar one to this one around the 1 to 2 time, and he was like that 2x, the ratio of the 2x, the 250 and then the 500. He's like, it wasn't doing so well. So I was just playing with the numbers. What do you do if it? How does it do when you lower it? How does it do when you make it a closer ratio? So I started with 250, went up to 300, saw the edge increased, went up to 350, saw the edge increased, went up to 400, the edge started to flatline. So I was like, all right, 350 seems like the sweet spot. And then I played with all those times. These were the best times. 159 was, I know that's super. He's probably gonna, Mark's probably gonna be
We're
mad
all
at me for
good.
not doing two.
159 is good.
But I did two, and the edge was less than at 159, so I just ran with it. And the interesting thing is what I found with this trade, when I sized the stop loss and the exit higher, it also reduced the draw. This draw used to be like 15%, and now it's at like 7%. So could be an inflated back test. Very well aware of it, but I was also see, hey, there's edge here, and even it's performed really well in 2024 too. So
Yeah.
I think
So
it could be a decent one.
I'll kind of talk about what I like about this one. So I'll start about 3 things I like and 3 things I don't like. So 3 things I like is the high stop loss is actually kind of nice because kind of what this tells me is that it's basically impossible to get double stopped on this. Like,
Yeah,
it's going to take a big stop, which kind of sucks. But if it reverses after you get stopped out, it would have to reverse so much that you're not going to get stopped out. And I think the main reason for this is since we're later in the day, options tend to decay into expiration and they tend to decay more into expiration later in the day. So it's going to be hard to get double stopped on this. Then I think the slippage is right. So if you look at it, we have a 350 put. If you times 350 by 450, that's roughly a $15 stop. If you times that by 2%, which would be exit slippage, 31 cents. So that makes sense. And then when we look at 550 on the call, since you're collecting, less of a premium, it's still going to be around that $15-ish mark, which will still be that 30-cent slippage basically. And then also in regards to this, like it's kind of delta neutral, even though we're collecting more premium on the put because, delta wise, you're going to be able to collect more premium on the put side than the call side. So that's just something kind of good to note. Then things I would improve on this, I'll see if you pick up on this, but seeing that we could have an 8% drawdown with a 100 grand account, which is going to be Connor's account, and we're already running other stuff. You've chosen 4 times here. What do you think is a way, and they're all within 20 minutes of themselves. What do you think would be a way to forward test this in a way that if the trade deviated in the future, it would not hurt us materially? So, I don't think it's bad. There's a way we can run this that won't present us to a drawdown. So if you could think of a way that
it's not
by
early exit, is it? It's not. It's
so I'm going to give you a hint. If you look at those 4 times, they're all 20 minutes apart. So if
Yeah.
we wanted to take less risk, what would be the easiest way to
Do
reduce?
140 and 159 instead of all three of them.
Okay, so now we're at a 3.5% drawdown, which
Yep.
would present, less of a risk or worry to us. And then the
Yeah.
other thing is this has 5,000 trades, so that's also good. I'd be a little more confident statistically on it. However, it looks like the ultimate year for options trading, 2022, is kind of pulling a lot of the weight with this.
Yeah.
So a few things I wanted to highlight on it is that if we get rid of the legs, because when you're buying back a $3.50 option that may be $20 in the money, that long leg that you normally buy for, let's say, let me see if there's a put here. Oh, it's looking like 5 cents, but like that could be 30 cents when you buy it back. So
Yep.
I just kind of got rid of the long legs and added a little more entry slippage to basically take account for the 10-cent long legs on entry slippage. So you can see that we, lost a little bit of premium capture here, but
Not
it's
bad.
still, yeah, it's still looking in line. Then I ran it to 2020, and we do witness that things can go bad.
Yeah.
However, 2020 is an outlier. I think
Yeah.
what we could do here is we'll cap it at a 30 VIX, saying that like when stuff gets irrational, we don't want to play with this.
Yep.
But basically, I think what we'll do in the big account is we'll just do one time, and we'll run one time for a month. And then if we're, above a 10% PCR for that 1 month, then we'll add another time.
Makes sense.
And then we'll kind of go more of a slow iteration, because this is kind of the most responsible way. And I want you to take off your risk hat and put on your 100 grand exit velocity hat. Now, after kind of our conversation and journey, what happened, I know you're just seeing dollar signs, but here's a concept that I want new 100 grand Connor to understand is if we make 30% with 100 grand, that's 30 grand. Whereas if we make, 70% with 50 grand, that's also like 30 grand. So you could still get your money. It's
Yeah.
just going to be way easier and way smoother and kind of a better route. So I guess after this conversation and kind of what you learned, what are your new thoughts or insights that you gained from a portfolio perspective, and then maybe looking at individual trades in the future?
Yeah. I mean, that's a way to tee that up. That was a great question because, like, I think, and I'm just going to say everything that I just thought right off the rip, but taking the cap off of the print and money hat, like when you're looking at the plus side of it,
You're still print
we're
money, you're not
actually
printing
gaining.
percent returns.
Yeah.
Yeah.
I got to be more when I'm building out trades and when I'm looking at my portfolio. I also got to look at the risk side of it, like how much I need to gain back to actually get back to where I was or break even for that month.
And what
Because
do you think is an objective number that you would say this gives us like some wiggle room for safety for a max drawdown for your portfolio?
if I'm at 100 grand, man, because like how much did we just face there? 19%. Like
And it could have been more. We saw
it
that.
could have been easily more.
Yeah.
Like I would love. You've always told me this in the past, and I think it is a pretty good number, just like a 10% draw.
Yep. Okay.
Like I
There we
feel
go.
pretty good about
Yeah.
that. Like just because like if you have 100,000 and you face a 10% draw, like that you still got plenty of room.
Yeah.
Like you got plenty of room to come back. You're not killing yourself there.
So we'll have Connor go ahead and do his homework on all of the trades, and then we'll have him present his $100,000 option omega portfolio to kind of look at next time. And the caveat that I'll have with this is like you're going to present your 100 grand portfolio that you would run at full size. So that's our back test. But then you're also going to present how you're going to start running it in a smaller size, and then your plan to basically add size to it over 90 days till we get to the full size of what we think. And what this will do is, since this is a new concept and a new way for you trading, is if we make a mistake, it won't prevent us from getting to our goal in the long term. Like our goal is ultimately like by the end of this year, which would be 2 years of Connor learning options, he basically has a set it and forget it portfolio that can make as much money for him as possible with a 10% drawdown. However, to get to that path, it's actually much less risky if he chips away at a smaller size, and then every 2 weeks or month, we start with just the 140 trade for the Connor trade that he just showed. And then 6 weeks later, we add 140 and 159. And that's kind of how we'll slowly do it, because this is where everyone's screwing up. And since Connor's on video, we're going to make him go slow, regardless of how much money he makes. And we're going to make him compare his back tests every time. And this is actually the best route to get to the phase to where Connor can just work and he can print money at a responsible, mentally good size instead of being in such a rush to do it. And young men have a huge problem with this. So like, we're watching Connor's trading grow up on screen as we very much see it. So I'll leave it open to you if you have any more questions in regards to that. But
I think you tied it all really well to the last video. You talked about forward testing, and I'm like, all right, now I get the concept of forward testing. Like, all right, I didn't really understand what that meant before, like how we're going to size it appropriately. And this is going to be, all right, I present my said portfolio, let's just select one time for each trade if it's a multiple time entry. And then, all right, we start adding little bits and pieces to it as it proves to ourselves the math is working. And then once it's there, I can kind of, hopefully in a year from now, I can kind of be like, all right, this is my portfolio. This is what it's going to print money for me while I'm working. Is that kind of the concept?
Yeah. And this is the whole active investing that people get. So it's like, you can clearly learn option omega pretty quick, but you probably won't actually learn how it goes in actual life. So like, you're going to make your portfolio and your plan, and all investing is making a plan, evaluating why you think that plan would work, then basically tracking that plan and following through with it. So you're basically going to make the plan in a week or two of what you're going to do. And we'll go through little iterations and decide what we're do that. But then we're basically going to start it at a smaller size and earn into that plan over the course of like 3 to 6 months. And by doing that, think of it as like you have a personal trainer and a workout coach, but like you understand, in order to run a marathon, obviously marathons are harder to run than just clicking a button on automation bots, but like you're going to be putting in all the miles ahead of time. So like, this is basically like the brick wall of, Connor's financial forge, Fort Knoxer's family, but he has to lay each brick individually, which will be the iteration of where we go with this 100 grand account.
It makes perfect sense. Yeah. That's all you answered everything I had. Thank you, brother.
Sweet. Well, if you guys have any other questions for Connor, let him know, and then we'll be all good with this. So we'll see you guys next time.